This podcast is brought to you by HEC Paris.
Okay, so well, before I wanted to add that this event is broadcasted will be broadcasted in iTunes University. So we appreciate very much the work from the technicians. I wanted to introduce just briefly the financial crisis. It's very difficult to sum up in 2 minutes what happened in the last 4 years. I tried. Let's see if it at least puts the perspective on where we are today, how we got here, and opens questions how SRI could have contributed to avoid this or not, and whether we are looking at SRI information should be using that to prevent future crises. So actually, if we go back already to 2006, we see HSBC announced their first losses linked to the subprime crisis. A number of banks followed. Bernsteins in Germany, Sachsen London Bank, UBS, we already 2007, and by 2008 we have Northern Rock that got nationalized by the UK. Okay, up to there we're talking about banks. We're talking about individual banks. By mid-2008, the oil had been escalating and touched almost $150 per barrel, and the summer started. Okay. And all these names will become part of the economic history in different ways. Freddie Mac, Fannie Mae, certainly Lehman Brothers in September 2009, where it made the headlines of the financial press, any other kind of press, and they fell down. Lehman Brothers closed. And with them, a number of banks started having deep troubles. We were talking about billions of dollars of losses in the market. This turned out into something different. So states decided to save these banks, and because of that, some of them started to have troubles. Started with Iceland, that after nationalizing some of the banks went almost bankrupt. Ireland, that after assuring the assets in the banks for a big number, they also started having troubles. And they followed by the rest of the European Union that actually started taking measures against that. They started the stimulus plans. Spain was the first to release it. France and Germany followed. And then we have Obama, yes we can. We arrive in this situation, okay? You need a lot of hope to get off these big troubles, okay? Remember, Obama was elected in November. September, all these things were happening. He took position in January. And at the same time, around those dates, the crisis had spread to the real economy. The car makers were having deep troubles. So welcome, Mr. Obama. Soon after, the credit rating agencies started to take measures. Okay, they started to rethinking what was going on. Before these events, the Eurozone was a credit-free risk area. And we started looking at countries individually. So Iceland and Ireland were the first. Spain got downgraded. But then the G20 took office, and we're going to reshape the financial markets. So markets started to keep up, but individual countries keep having troubles. Greece was pushed once and again in already 2010. And then Portugal, Spain, Ireland got downgraded once more. Greece again Greece, Ireland, Portugal. And it goes on and on, okay? By this summer, the European Central Bank decided to take unprecedented measures. They bought debt from countries, and that was the debt of Italy and Spain. Nevertheless, last week, both were downgraded. And the last news we've had is the troubles that Dexia is having and how this could be affecting also Belgium, okay? So that was a very short number of elements that I'm not talking about. We're not talking about banks that we are still having troubles in all these countries. But the point is to show how we shift the message from banks, from the corporate sector to individual countries and to countries. And now we're talking about systemic problems in the Eurozone, okay? So starting from that, what could have been done? Okay, what should are there tools that could have helped prevent getting there? We usually look at these measures. Okay, so we see the moment that the stimulus packages started taking off, the countries started increasing their debt. That's normal, and with that, the prime of the debt also increased. So we see on top Greece and Italy with more debt, but countries like we've seen Spain is in the bottom. Spain is here. So the problem of the GDP, the debt on the GDP is not the big issue for Spain. The prime of Spain is higher than Germany and France, but it's far from being Greece, right? So what else could we be looking at? Okay, so that's the main purpose of this event, and you know there are some alternatives here. Oliver is going to talk extensively, or more extensively, about the indicators. There are just few that might be interesting to look at. We see Portugal as have a higher renewable electricity percentage in Europe. That should be taken into consideration. Is it taken into consideration? So those questions we are hoping to open up and hopefully find some answers, or at least get some debate about that.
These alternative indicators refer to what we call SRI, so social responsible investing, as from a broader perspective. Just for you to have an idea about what SRI is today. These figures come from Eurosif, which is the organization responsible for lobbying SRI at the European level. We can see that there has been a major increase of SRI over the past few years. Today, European SRI market is estimated at 5 euro trillion asset under management in total. And core SRI, which refers to consist of norms and values-based exclusions and different types of positive screens, are representing 1.2 trillion. Whereas broad SRI, which encompasses simple exclusion, engagement, and integration approaches, represent at least 3.8 trillion. So just for you to give you an idea about the importance of SRI now, it says that out of $8 in U.S. equities is SRI, in Europe equities in SRI, and one of 8 in U.S. and one of $6 in Europe in the equity funds. But when it comes to bonds, the story is a bit different, especially regarding sovereign bonds. So on the other chart, you can see that there have been a growth of SRI regarding bond and monetary funds definitely, because the bonds has increased by 33%, and monetary fund by 114%, which is a major increase, whereas the mainstream funds have been increased only by respectively -5% and 4%. So we see that there's a shift from SRI funds, from equity SRI funds to bond and monetary funds. But when it comes to the total assets of SRI funds, still equity SRI funds represent 55% of SRI assets, which remind you, equity funds represent $1 out of $8 in the US in equity and $1 out of $6 in Europe. When it comes to bonds, it's only 33%. And when it comes to monetary, it's only 1.6. The other ones are hedge funds, other types of funds. We look for figures about sovereign bonds, but we didn't find some. But we can imagine, according to informal discussions, that around the 33%, only few persons are sovereign bonds. So today, SRI sovereign bonds are really marginal in the SRI field. We also looked at we also looked for figures about the number of sovereign bonds, which will include such type of alternative indicators like public spending on education, renewable electricity, CO2 emissions. We have many types of non-financial indicators, not usual suspects indicators, but we didn't find also some figures about that. It seems that they're still quite marginal, the number of investors who really invest in sovereign bonds with this type of indicators. That's the reason why also we wanted to make this conference, is to get a better understanding of what occurred in the sovereign bond markets, what the SRI investors are doing, what they're not doing also, and just for you to have an idea about why we choose our three speakers today. This is a really succinct presentation I've heard of the financial market, which is really easy one. So first we have the research providers, can be the rating agencies, you all know, Fitch, Moody's, Standard & Poor's. They can be social rating agencies, that's IOCOM Research we have now, specialized in alternative indicators, environmental, social, governance criteria. And we also have the brokers. These people provide research, provide information that should help investors to make decisions, long-term, secure, profitable decisions. They're in the left, at the beginning of the value chain. Afterwards, these research providers sell their services to asset owners and asset management companies. Asset owners, they own the assets. They can be pension funds. We have the ERAF to them. Employing saving funds, individual investors, insurance bank companies, which refers to any organization or any individual having assets. Okay. When it comes to sovereign bonds, usually we speak a lot about institutional investors, which are major organizations having a lot of money, less retail investors. These asset owners can invest directly into the sovereign bonds, into the capital and sovereign bonds, or they can use asset management companies as intermediaries. These asset management companies also invest in sovereign bonds. They have in their company, both asset owners and asset management companies have their own SRI analysts, financial analysts, that should analyze and use the data provided by the research providers to make investment decisions. So we have at least two levels of analysis. These people invest in sovereign bonds, and these sovereign bonds afterwards they are issued by the national governments. Okay, so we don't have to forget that these sovereign bonds comes from the national governments, and after they are there to provide money to the national government. So the errors could be in both ways. This gives an idea of the flow of capital of we can see in the financial markets. But what we have to look at as well is the stakeholders. These people are making investment decisions, but they're not alone. It's not only the financial analyst, it's not only the asset manager, it's not only the asset owner by himself. It's not. I don't think it's only Olivier Bonnet by himself who choose everything for ERAF. There are stakeholders. The beneficiaries play a key role. They can be represented by investment committees, by organizations such as CalPERS, for instance, in the US, play a key role. They try to represent beneficiaries. There's also the regulators. They play a key role. Why? Because they can make some constraints. They can forbid banks to invest in triple B or triple or double A, whatever rating countries. So they play a key role about putting constraint and also about controlling the behavior of the asset owners and the asset management companies. We have the civil society, which has play a role over the past years. Like, it means that it seems that civil society, like the public audience, are considering and discovering that the financial sectors investing money and it has an impact on the whole society and the whole economy. So they start questioning the behavior of the financial people. And lastly, we have the international organizations, like for instance the Principle for Responsible Investment, which try to trigger development of SRI at the European and the global level. There's many international organizations that try to promote the development of SRI. This week is organized by the French CIF, which is also a way to promote SRI. And that are part of the story as well. And we have the banks. Too, that they play a role as asset owners. So we choose today as 3 speakers because we think that they represent a part of the value chain. We just missed the asset management company, but it's for next year, perhaps. And we focus on the first research provider. We are going to start with Oliver, because it's going to explain how the assessment of sovereign bonds works in practice in this social rating agency, and perhaps the difficulties they face to sell this information or to assess sovereign bonds on alternative indicators. So we start by him because it's the beginning of the value chain, I guess. Afterwards, we're going to have Olivier Bonnet from the ERAF because he's an asset owner. So we are going to ask him what is it doing in his company, in his funds to favor long-term responsible investment in sovereign bonds, what it tries to do, and especially what the difficulties it faces to make something responsible investment in long-term oriented in sovereign bonds. We're not here to judge. We're just here to try to understand, to deconstruct the mechanisms to have a better explanation of what occurs now. And lastly, we are going to have Daniel. Is an academic, so he's not has such in the value chain, but is working a lot on the approach of the Spanish government about in communicating to the financial market. So he's going to explain the position of a national government and is going to deconstruct that. So we're going to have, we hope, a broad overview of the different flow of capital and value chain regarding our question, or to the question of it, sovereign bonds. And that's the reason why I'm going to give the floor right now to Afshin's going to give perhaps a more precise introduction of each speaker. And we're going to start the presentation with you. Thank you very much. I hope you will enjoy the conference, and we are going to have stimulating exchanges and controversial exchanges as well.
Please visit us at www.agc.edu.